it's the future that counts. It's like what I wrote there, what Wayne Gretzky says, to go where the puck is going to be, not where it is. So,
hi, Philip King from San Francisco. I've got another question about valuation. More specifically, the relation of PEs to interest rates. I understand that you don't want to lay down a rigid formula for valuation, but I also know that you don't want people to think that a multiple of 20 times earnings is cheap or a multiple of 5 times earnings is expensive. Benjamin Graham, he devised a central value theory that valued the average stock at an earnings yield that's about a third above bond yields. In other words, that would work out to maybe 11 times earnings currently. And I know that you've compared the average business to a 13% bond that's worth roughly book at 13% interest rates and worth perhaps roughly twice book at 6% interest rates. So given current interest rates of 7 to 8%, as they are now, that would tend to imply that stocks are worth perhaps 12 to 13 times earnings. And yet the acquisitions that I've seen in the private market have gone out at more like 17 to 20 times earnings. And I'd like to know, what do you think is the rough range of multiples that makes sense?
Yeah, well, it isn't a multiple of today's earnings that is primarily determinant of things. We bought our Coca-Cola, for example, in 1988 and 89 on this stock at a price of $11 a share, which as low as 9, as high as 13, but it averaged about $11. And it'll earn, we'll say, most estimates are between $2.30 and $2.40 this year. So that's under 5 times this year's earnings, but it was a pretty good sized multiple back when we bought it. It's the future that counts. It's like what I wrote there, what Wayne Gretzky says, to go where the puck is going to be, not where it is. So the current multiple interacts with the reinvestment of capital and the rate at which that capital is invested to determine the attractiveness of something now. And we are affected in that valuation process to a considerable degree by interest rates, but not by whether they're 7.3 or 7.0 or 7.5. But I mean, we will be thinking much differently if their long-term rates are 11% or 5%. And but we don't have any magic multiples in mind. We're thinking we want to be in the business that 10 years from now is earning a whole lot more money than it is now, and that we will still feel good about the prospects of the business at that time. That's the kind of business we're trying to buy all of, and that's the kind of business that we try and buy part of. And then sometimes we buy others too. Charlie?
We don't do any of that rigid formulaic stuff.
There's a general framework that you can call a formula in our mind, but we also don't kid ourselves that we know so much about the specifics that we would actually make a calculation in terms of the equation. When we bought Coke in 88 and 89, we had this idea about what we thought the business would do over time, but we never reduced it to making a calculation. Maybe we should, but we don't think there's that kind of precision to it. We think it's the right way to think in a general way, and we think if you think that you can do it to pinpoint it, you're kidding yourself, and therefore we think that when we make a decision, there ought to be such a margin of safety that it ought to be so attractive that you don't have to carry it out to 3 decimal places.